Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. My partner Ryan's working on our market outlook overview for the week. It's Sunday, March 26, 2023. And let's see, what time is it here? It's a little bit in front of 11:30 on the East Coast, 11:30 a.m., of course. Let's get some stuff flashed, and then we will start to move into things. And this is not a complaint. There's our trusty disclaimer. There's our trusty intellectual property rights notice. And here's the program. I'll leave this up for a few seconds. It's a lot to digest, but just want to say, my gosh, I just think it's been such an interesting year. I think we're set up like where last week we had an interesting week. We were expecting sort of what we got, I think. And then, we're just right back at it again with another interesting week, all kinds of interesting developments. Making it really difficult to really have a strong confidence. And I'm just already tired from not cobbling all the information together. I'm tired simply from sorting through it and trying to focus things. There's just so many things out there that might be worth mentioning but that's the time, right? That's the time we're in. So we just got to deal with it the best I can. So yeah, we're going to get to it. I had to just cap it and say, if I keep bringing all these links I saved and Ryan sent me and things like that, we'll never get through this. It is what it is right now. So let's just do the quick recap. The quick recap was we were disappointing as usual. And when we get into markets like this, where we were concerned, there were a lot of, I think bulls really were on the verge of losing all control. That was obvious. And Friday, I guess, changed that. But we really were thinking, let's just expect volatility, see what happens after the Fed. That was the game plan. We didn't really have that most likely scenario because of that Fed wild card. And I think that was the way to go, really, fortunately, in the end. So if you like just staying nimble, doing what you could before and after the Fed, it may have worked out for you. I think Friday was very dubious, but I have to note that I do think that the bulls had their bacon saved by Friday. I really do think things were looking as if they were heading off the cliff, but they saved them. Now you could say, well, I think it was BS. I think it was zero DTE shenanigans, and there appears to be some of that. For sure. Other factors, you can't rule out just people looking to buy for whatever reason. There's always a lot of different factors, but in terms of the main factors, maybe zero DTE, maybe the Yellen meeting that was unscheduled. And then, in my opinion, someone turned on something equivalent to what I was calling the WAF algo back in the second half of 2020, in 2021 and 2022, when you would just see this kind of calm, relentless bid that just never went away. And it would let things back up a little bit and then just start buying all over again. That's what it reminded me of. That could just be me extrapolating. It just had an artificial feel to it. So I'm here to deliver disappointment in terms of the current market. And what I mean by that is, I don't think you can have a strong lean right now. I thought I got rid of that one. So I wanted to just have, regardless of our take, we can just save time right now and just say, forget about the FOMC reaction. That was a little editing problem. I think you have to just wait for a breakout or breakdown and see what news is on the way. Clearly, the financials remain the lead story. Crypto is still trying to shine. We saw some more difficult developments, but then they did rescue XLF along with mostly every other sector as well. And I think what it's coming down to, the way I'm viewing it, is it's simply the very bearish sentiment versus and maybe some increased liquidity versus a lot of bad stuff that's on the way. And so the unfortunate thing for folks that don't believe in these rallies, which I can't say that I'm unsympathetic to your cause, but the folks that are thinking this is hogwash, I'm there with you, but these guys the gang can do quite a bit between now and when reality is finally dealt with, and a lot can change too. So again, it comes down to just trading the price action and the momentum as best you can until we get something more clearly defined. I do think if they break this market out, there could be another very rapid short squeeze. We've seen so many of those once it's gotten through big levels. So that might be the day where you don't trim, you don't exit, or those days, I should say, and you really more or less be an aggressive roller and try to stick with it longer if you get that. But that's a big if right now, and I'm not necessarily predicting that. I'm just saying that it could develop that way. My way of looking at it is I still think the housing market's the biggest deal of them all. And we'll talk about all these other things. I might come back to this, but I don't want to go through them all, but we'll go through a lot of these points. What I'll try to do is stop sharing. I'll reposition everything so we can see what we're up against here. And then if I can get this off that screen and start covering, we can share this other screen here. This would be helpful. So hopefully when I share this screen, we'll be on rate probabilities, target rate probabilities for July. And I just want everyone to see that where we are right now, if I jump back to May, the current target rate is right here. And if you look at, this is what they're expecting now by July. They're saying that we go lower by July. So this has been massive. I mean, this has just been an absolutely massive shift because of this banking crisis, apparently, at least that's what they're assigning it to. And there's a lot of fallout from that. So let's take a look at this, which Ryan sent me. And I think this is a really good, this tweet from this group here, Markets in Mayhem, whatever exactly they do, I don't know, but this is a pretty nice graphic just to show you, right, where we've been this year in terms of where rates were expected to be, right, across time, across the curve. So watch this. It doesn't take very long, right? We're only talking about 1 minute here. Watch this. This is just remarkable. Look at how things really mid-January, right? The curves moving like this. And then I think you start to see where the inflation data starts kicking in, that it's not going away, right? It's not as transitory as it was expected. And there's the hot inflation data really starting to move, right? Move the curve. And then it gets really even further extreme. You'll see that. And this is really just a month ago, right? This is only 1 month ago. Now we're talking 2 weeks ago. And now look at this. This is just remarkable, right? That you don't really see. I mean, this may have happened before and I missed it. But I mean, to me, like, that is just an incredible graphic representation. So kudos to whoever put that together. But that just gives you an idea how things have moved. And I think, right, that's what's driving a lot of these buyers, people that are just showing up and saying, okay, it's time to move money in. But what we have to do is go back to, really quickly, I'll jump on the PowerPoint as a reminder. We can't not show this, so just bear with me when I get this back over here. And I just want everyone to see this right here, because remember, if you haven't seen our videos before, right, we're relying on other data that we find because we don't have a staff or anything. I could use a staff. Ryan we could all use a staff at this point. But the point is here, right, is that when you start to see the Fed funds rate start to roll over, right, or on the cusp of rolling over, just after that, you get the recessions in the gray vertical areas. But then also notice, right, that this is when the market itself, they're representing the market here, but with the Wilshire 5000. But this is when the market too rolls over once the rate eases start. So I don't know if that'll be it, right? It's going to be that easy. But if what we just saw there is true in terms of the CME Fed Watch tool, right there, they've got things dropping by July. So again, that makes it really, just keeps everything very, very interesting right there. So that's what I think you have to look out for. Now, we did see this, got another thing. I pared things down too. This is also just a reminder of where the latest, right, LEI that I was able to find. We used this last week, but you could see, right, that this is the GDP does a pretty darn good job of following that. Now, beyond that, there's this one, I think. Yeah. So let me get this to kind of pair up with that, right? With that LEI and what's going on with GDP. So here's Bloomberg, and this came out, I think, right last week. And you can see, just check this out, suggests new Fed forecast suggests bank is bracing for recession, right? So imply a sharp slowdown through the remainder of the year. So to me, right, this is my case of, I think that there's this bearish sentiment, right, that I'll show in different ways. And then there's this liquidity that's maybe making its way into the markets from what the Fed's doing. I don't know that to be the case 100%, but folks are already arguing that that is the case, that what the Fed's doing is bringing more and more liquidity into the market all over again. We'll have to see if that sorts out that way, but let's just see where we are right now in terms of what I'm saying in terms of sentiment. And if we look at the AAII, this is where we are right now at 48.9. And so if you go back and look at the data, right, this is about as bearish as it's been since late last year, with 10 days to go in the year. So this whole, we've gotten right back up to pretty bearish, and I think everyone knows what happened right to start this year, and we were in bearish territory, right? Essentially, the sentiment was really poor. So if you look at it that way, here's where we are too. Now, this is why another thing where I think it's tough to say, well, what do you think about this market right now, and how can you have confidence? Last week, the market was up, which we'll see when we get to the chart phase. But notice right here, right, the percent of stocks above the 20-day moving average dropped. That's not a nice looking candle right there. It's still more or less in an area, though, that we've seen things improve from. In other words, the market, when it gets down towards these levels, the market tends to put a rally together and move stocks back above the 20% moving average. So there's something for bulls and bears here right now. If we jump over to the MMFI, okay, at Market Rebellion's site in Elite, right, in UOA Elite, look at that. That was a rough finish for stocks below the 50, but again, you're down near the lower levels. But you can't really like that in the short term, but at the same time, right, that it doesn't really go all that much lower. Sure, it can, but it just doesn't go all that much lower. So that's the kind of conundrum that we've got here. We may as well just be thorough, and we'll take a look at the 200, right, stock percentage of stocks, and that has more room to go, right? And that had a poor finish, but this is also a level where they bounced it from strongly before. So we will see. But overall, that one certainly looks the most vulnerable. And you can't be happy, I think, if you're a technical bull, that things maybe held up, and maybe they might even break out, but I think they look really dubious in terms of it's really time to fire. So there's a lot here to unpack, as people say these days. There really is, though. I mean, it's really an interesting time. Here's what I did here. I just put a 21-day just to see where, over the course of like effectively a month's worth of time, where the put call ratio is, to see an average of that, because it's, put call from moment to moment gets a little sketchy to really read and divine anything from. But if you look at this, you can see that you're up there in terms of where put call gets to, right? And this is these higher levels that we're at on the moving average. These were just about coincident with or showed up prior to little tradable bottoms. So the fact that this is part of my argument that sentiment's as bearish as it's been in about 3 months, put call ratios up there. We were just in extreme fear. We're still in fear, right? And so you've got all that on the one side saying contrarian stuff, right? This is probably a legitimate place where they could try to start buying and create their latest, in my opinion, probably a bogus move higher. And we'll take a look at many other things. Unfortunately, I wish there were just a few more things. But this is why, right? They could do this in the face of this. We had Deutsche Bank and UOA Pro. Fortunately, it tumbled not as much as I thought it could. Maybe there will be more, who knows? But right, there's a lot of stuff like this that's freaking folks out, rightfully so. I mean, we actually always joke about a European or Asian banking crisis pretty much always tips things over, but that's been the case. I mean, it's just been the case many times. And here we go again, right, with Credit Suisse. And there was talk that UBS was backing out of that, excuse me. I don't know where it all sits, to be perfectly honest. My head's spinning between all the activity we have in the services and the kind of market we're in, and trying to help out folks within that, and then trying to keep track of all this other macro stuff on the side. It's even with Ryan, myself, Greg, my son Pearson helping out. It's still a lot when you're busy all day long. You don't have a lot of time during the day to really do much else. But so, you know, how can you really be a comfortable bull right now? I don't think you can. I mean, if you could tell me with 100% certainty how, you know, the Deutsche Bank issue and other European banking issues won't develop, create real serious turmoil, and then possibly spread as a contagion, then please tell me how you're doing that. I'd really appreciate knowing something like that. But I don't know how you can be confident in that. It doesn't seem like the market's confident in that. And, you know, that's the next thing, right? We have people are now really starting to talk about commercial real estate being next. This is commercial mortgage-backed securities that, like, these, nobody wants these. They're getting out of those. There's certain players. I think we have AGNC. Some people were making the case that AGNC holds a lot of this stuff, or may potentially holds a lot of the stuff. So that's something potentially to research there. But you know, this is not a good look. We know what this has led to before. Now, again, part of my argument is that the real estate sector is absolutely critical to the fortunes, right, of the US GDP. That's just the way that it's become through all the, you know, absolute manipulation of everything by these utter, I don't know, buffoons is putting it kindly, utter buffoons that have been managing our affairs, or mismanaging our affairs, for decades and decades and decades. But as it stands right now, just notice that the fixed mortgage cost 30-year is a whopping $1,176 more than renting an apartment. And that's really strong. I mean, that is really strong. So that kind of tells you, as things are priced right now, how folks may be willing to move to more of a rent situation, since, right, this is the largest it's been since 2006, which is saying something, right? That was quite a year, right? The way that mania unfolded. So to me, that's a sign, right there, that people just don't throw that much extra money out willy-nilly, excuse me, especially when they're getting hammered by inflation on many other things. So I think this has been my main contention from way back. You know, I remember a couple webinars we had John on, or it was cocktail hour, and he was in agreement with, after Dirk had asked me about it. And this is to me, it still remains the big problem among other problems. But this is the driver of this economy, and has been. And I don't know what happens here in terms of the macro. This can't get you the story. I'm not a premium member, but you know, this is the Goldman flows guru. Extremely negative sentiment and short positioning, right? So they're on the sideline right now. Apparently, if you can read the whole piece, that's great. But we don't have access to it. But the point is that that's how they're seeing it. And extremely negative sentiment and short positioning. And that's literally what helps these inexplicable, dubious, artificial, whatever short squeezes. If you just want to make it simple, that's what powers these things. And then they start to take on a life of their own. Momentum players like us get involved in the short run, and it's just, you have these real, you know, quick melt up type phases. So I'm just telling, the reason I'm going through all this is because it's so easy to be a bear right now, I think, in the short run, and you have to be careful. I think you still have to go for your singles and doubles until we break out or break down. And if you do get the breakout, like I said earlier, I think you've got to trade it with a lot of rolls, because they could really, I mean, these guys are just the best I've seen at going for the jugular. They will just go right for the jugular, and they'll just utterly annihilate people that are aggressively short. And it's the game within the game. I didn't coin that phrase, of course, but that's the reality, I think, of the situation. You've got to be respectful of both sides right now, because which of us, or who among us, can say, well, what's going to fall next in terms of hitting the tape news wise, in terms of the banking situation. That could turn things down seriously on news, and it could be real, and it could really drive things. On the flip side, you could definitely get with all that we're seeing here in terms of market sentiment and the fact that it's so easy to be a bear. And I think bears are going to be right, as the Fed article from Bloomberg noted. I think towards the end of the year, there's going to be this slowdown. The way that that's why I've been able to keep saying week after week that I think a lot of bad news is still yet to hit the tape. And once that starts to hit the tape in a bigger way and becomes more mainstream, that's when the Fed's either just about to cut or has been cutting, and then the market reacts to that, and then you get your final, that final washout phase a lot of the times, which becomes a great buying opportunity most of the time, from my recollection. But that's jumping way, way, way ahead. So what I'm going to recap is that in terms of the internals, right, we're seeing a lot of the new lows versus new highs. So I don't want to skip over that. I had that laid out. Where did I have that? I thought I had that over here from Market Rebellion. Let me see if I can do that real quick, because I wanted to cover that. New lows. Let's just pick the NYSE new lows, but you can see that right there. I mean, those started spiking, just kind of like, put call with, there's a lot of puts trading relative to calls on the average we looked at. If you look at we'll do new highs and we'll do new lows. I'll put new highs. Let's see if I can get that. If I can type a little bit. Did I just have it there? There it is. Okay. So you can see that downticked, right? There's nothing really good happening there. So, I wouldn't say you're bombed out, right? I don't think you're bombed out, because we had a week where they managed to save the market, right? They managed to mark things up. But sentiment, I'll show this first now. So I added this just basic market sentiment indicator, and I wanted to show this IYR too at the same time. So let me just show this IYR picture. That's the US real estate ETF. Now, we did have a big UOA hit out in October, I think it was, where somebody bought a downside put spread either on Friday or Thursday. Let me fix this annoying percentage thing. I apologize for this every week, probably multiple times too. But you can see this, right? This kind of followed that broadening wedge type pattern the market had in place this year, and now it's broken down again. It looks like, to me, it's in the middle of another leg lower, much like come down, hesitate, go again, come down, hesitate, go again. You're probably due for a corrective wave. And the reason I'm saying that is because if you look at the RSI, on the low, it probably got darn close to being overbought and found support just about where we'd expect it to, right? Look at here, look back here. So this looks like a short term, probably they're going to try to support it type of thing. Overall, it's hard to like it at this stage. Clearly, that's the issue. So I don't know if that player was buying some partial insurance down there, or they're just expecting all hell to break loose by October. We can never know for sure. But this is an area that people ask about, so I thought I would mention it. But it's just indicative, right, of what we've been talking about this morning, and really for years at this point, really. But especially of late, right? So this doesn't look very good other than short-term overbought, right? If it puts a bounce together, fails, and starts coming down and through, then you're going to see, I think, really serious, even more serious selling kick in. So just keep that in mind. But if I bring up the SPY, what I'm going to try to do is just give us the, you could just see the sentiment indicator. Now, again, this isn't infallible, but this is still down in the dumps, right? If you go back and look at things, it was riding high, of course, into early 22, and then I'm sorry, late 21, then started rolling over, and now it's down here, right? So things in this view aren't very good, but I wanted to really view it from more of a daily perspective. And the reason I made it so large here relative is that, look, this thing's right on the verge of making a lower low. It got stopped right at this prior low, but the overall trend is down. So does it put a bounce together? Don't know. Or does it just crash right through? Don't know. I'm just saying the potential's there, right? And when this thing breaks down lower and there's a whole nother leg of let's say poor sentiment, that's going to be coincident with that market. So this doesn't really lead. I'm sure really the price leads. So I don't want to, but I'm just saying it's there. It's kind of an interesting thing that it's right on the verge. And now we can get into our technicals a little bit finally, because there's a lot to talk about. But let me get to a better view. I think I have a different view here that might be, no, I don't have that one. I want this one. I might have to stick with this one for now just to keep it simple. And of course, Thinkorswim's got me again. Can't wait till I make a switch off of this at some point, but I've got to have all my custom stuff. That's the problem why I don't go off of it. I got to get my custom stuff to translate into a different scripting language, because this is just annoying me. But this is where we are in terms of, we said, look, there's a triangle in place, false breakout. Look at that, right? Then they have the false breakdown. Look at that, reverse it right back. And you're right back at the apex virtually of the triangle that we drew. I think we had this in place last week. So, why you would want to get, with all these different news possibilities that are in place, maybe they're saving regional banks. Maybe the European saving of banks will work. Maybe this, maybe that. To me, what you really have to do at this point is just decide to be nimble, because there's a lot of games being played. I think that Friday move was bogus, but we've seen many Friday moves carry on, right? Especially when you get poor sentiment, oversold conditions. So I don't think you can really rule out that this could still go. I don't think you could rule out that it can break down. If I go with a slightly different view, let me see if I can get the better view. So I pointed this out in Rebel Pit, and I'm going to try to, I can't get rid of this, unfortunately. I'll just leave the market sentiment indicator up there. But I pointed this out in Rebel Pit, that the bear market downtrend line, that's what they used on Friday morning to start the bounce from. So, the 200 there in purple, all these things matter, but this is the interesting thing about where you are, and just another thing that points to, just be nimble and trade until they show you the whites of their eyes, as a lot of people still like to say hundreds of years later. Because if you break down below here, again, always can be false breakdown or breakout. You always have to have that in your mind until you really see the momentum show up and the thing powers away from that critical level. But you're easily one bad day away from cracking below this line and all the SMAs. You're one good day away from getting above the 50, which would leave all SMAs to the south. And then you've got a couple of different resistance lines right in there. And it's very clear, we've talked about this 405-ish level before. That's a level that I think you have to pay respect to. I still think that 408, 409 is big. But what I'm getting at in terms of that short squeeze that I mentioned earlier is that if these guys get this going, let's look at this objectively, right? They still have a pattern, if you just general pattern to your eye of, they still have the higher lows put in. It might not be pretty, but they still have higher lows put in. And this could all end up being just, almost 100% corrective. In other words, all this stuff could be 100% corrective of this move that it made here. And that's not good typically if you're a bull to see that deep of a correction. but this is a different time that we're in, especially with all this news. So you have to look at it and say, is this kind of corrective channel we've been in, is the fact that it's still held above the lowest low, could that be really lead to another wave up, much like this corrective action here led to another wave up? Could you get that? Could it pass through that 418 madness that we saw on that one particular day? Could it come back here, close these gaps? Could it take this out? I think because things are so obviously bad right now, and we know what these guys are capable of, you just can't rule it out. You just can't rule even something that extreme. And I also think if they get through here, then there'll be capitulation, and you'll probably see maybe a 1 or 2% squeeze beyond that 431 level. And I think that's just the game within the game if that were to happen. So I think if you're really serious, and I know everybody likes the strong lean, but I don't see a reason to force a strong lean, especially because the bulls here's last Friday right there, and look where they closed. They managed to close up despite everything. Like I said, it was bogus. They were really on the ropes there that morning. Things looked like they were about to really unravel. The Yellen meeting, unscheduled meeting, and the zero DTE nonsense, shenanigans, whatever you want to call it, that really launched things. It seems, along with probably, again, other things. So I still think bull traps and bear traps are possible. And the bulls did come back and regain a small bit, right? A small part of control. And I'm thinking it's kind of bogus, but I would still just stick very closely to the price action. I would stick to your DDA. I would be, doing the rolling, the trimming, depending on how things are unfolding. And I would let this stuff play out to see where this news falls and how the market takes it, instead of trying to guess ahead of time, unless you have a really strong reason for that. And the other thing I would sort of caution against, because if I show one other thing we can look at here technically, and there's other things I'm going to cover too, but one other thing we can look at, and that's not it, it's this one. If you look across all these sectors, right? Excuse me, let me get a little water here. There's virtually every sector with a green candle, excuse me, on Friday. The only one that didn't was consumer discretionary. That ended up with not such a special candle. But everything else they turned at least into a green candle. Maybe not up for the day, but still a green candle. And some things really ran. And we've been pointing this out. I'll talk more about it in sector situation if I ever get this video done. But you can't really say, that XLK, we've been noting this, BMC noted it too. XLK, XLC, that's where they've been doing their best work. So what can you say about this, right? They came in for virtually everything. They rescued things that were making new lows, which these were former leaders that, the XLI was making new lows, and they put it together. I don't know how legitimate that is. Like I said, my gut instinct says it was kind of bogus, but I've already seen too many bogus Friday saves that have basically delivered more upside. So I think you're just in this very, very difficult period. Now, if we jump around a little bit, I'm going to bring up something. Here's the Qs, right? And they've been kind of like the leader. Now, you could say, well, they're kind of still, if you look at your RSI on here, well, you're still approaching overbought. You are. It could be a double top here, no doubt about it. But right, just think about what they're doing here. They're very close to a possible breakout, and there's unfilled gaps to the above. Like I said, if this is going to turn into the leader, which it seems like they're trying to make it, then they could try to pull things up big time with this. On the flip side, right, IWM has been something that's led the market down. There's been many times when I tried to point this out to the folks in Rebel Pit that, hey, like IWM is taking it on the chin. you just keep an eye on this market, because this could really unravel and become a problem if IWM keeps leading stocks lower. And it did. This is really the opposite. But again, they saved it. And you can't really argue with the fact that the RSI probably on the low is down near close enough to oversold, right, for us to consider it basically that way, right? So nothing tricky there. And you can't really rule out a Bollinger Band excursion here below the lower Bollinger. They're narrow, but you know, the proclivity is to fight your way back in a little bit. Not always a ton, but usually when you get there, they deliver at least some kind of a little reversal of some kind. When you get outside, the momentum shifts and they start coming back. They try to work it back in. So you can't rule that out either. But this doesn't look nearly as good as QQQ, DIA. We'll take a look at that. Excuse me. That, right, you really can't, I don't think you can really be happy with that. But this is, you know, this is where the games get played very clearly. These lows here are very close to what happened over here. And everyone can see that if this gave way completely, if they really let it go from here, the way that they march this stuff up, it would probably be back towards here very quickly, which, you know, it means you lose another almost another 1,000 points from these, well, we'll call it 700 points fairly quickly. But that was not allowed to happen. It didn't happen. If you believe the markets are true reflections of supply and demand, and there's no shenanigans going on, one of my favorite words, but you know, sentiment just doesn't look good. Except, right, we know these guys do tend to have tricks up their sleeve. So let's take a look at, instead of doing things individually, let's take a look at things as a package. This is what I was thinking about this week. And we'll look at Google. Now remember, and I'll show this too, Meta, MSFT, NVDA. I'll bring that up. And let me see if I can find this for us. Fed funds rate, is that it? No, that's not it. It's probably right here. Yes, so where did I have that at? I had a, yeah, this is where I wanted to get to. So if you take a look, I'll just ballpark this quickly. Apple and Microsoft get you about 25% of the Qs. You add in Amazon, you're at about 31. You add in NVIDIA, you're at 36. You add in both of the alphabets, right? Then we'll call those 8. That puts you at 44. You get Tesla, you get to 47. And then if we round things off, Meta gets you to 50. So if we look at these big companies, and I will maybe add Tesla after this, but if you look at the ones I've put in already, being that they're 50% of the Qs, I think the problem here is that they are overbought, right? They're short-term overbought. They're registering 71 as a package, excuse me, right now. So could there be a little bit of a pullback? Obviously there could be, but the sentiment, you can tell, right? And we all know this is where they've been heading into, right? The sentiment overall has been pretty good in those. And in terms of control, that's the interesting thing. When I look at what I just call like bull bear control, and I can see if I can, oh, this is so hard sometimes to get everything that I want to appear. I have a hard time finding it when it's, there it is. But I can just say, and it's obvious from this chart too, that we know who's in control. I mean, this is fully, other than the very short term, which is overbought on this, the bulls are fully in control of these things. So if we add, let me see if it lets me add to this, right? If I can just put Tesla as well, just to see if that changes much. Not really. And you're a little less overbought. So short-term overbought, but you could see that this bottomed out here, right? You had this nice strong push, took out many highs, cleared many highs, put in higher lows. Here, this low is above this former resistance level that's now support. So it held above there, above all the SMAs, short-term overbought. But as a package, that's what they're trying to do. They're trying to really do what the playbook was for many years, and that's keep these big names really buoyed, right? Keep those supported. And by doing that, you prevent the market from really getting smacked because people are like, wait, what's going on? It prevents really the full meltdown by keeping these things bid up. It masks really a lot of problems, and they're in control. You could say, well, what are you talking about? But how can you say that? I can just say as a package, they're in control. It's just, to me, it makes sense. Like that those are the big names that they're really, the price action tells you that, right? The momentum tells you that. So there's Apple, right? If you want to take a look at that, 66 on the RSI, that's the problem for now. But again, if there's going to be a squeeze, it may not matter. But that chart to me, if there were no news, we were in a neutral news environment, we were in a neutral market environment, I'd be more inclined to think about, let's wait for a pullback and buy that thing than start selling it. Excuse me. Amazon's a little bit trickier, but they managed to hold the 50 on Friday. Okay, so we'll see what happens there. Probably one of the least impressive ones. Google, there you go. I mean, this is back towards highs, right? This is trying to lift out of this range that it's been in, and it's not very far from breaking out and possibly doing that. Again, I would say that's short-term overbought, though. That's the problem with that one. Let's take a look at Meta. But these are almost all these stocks are in bullish control. Meta's been relentless. Meta is overbought, basically right there on the overbought level. And let's see if we can just get a full, I want to get a little bit more time here so we can see where the gap comes back in. But yeah, I mean, if they want to try to really put something together, we've seen madness develop before, right? It's not like we haven't. So I'm not predicting that. I'm just saying there's a lot there. If they could get this whole another squeeze going, this could be something really stupid that happens in here, to put it a different way. Here's Microsoft. I think everybody knows what's been going on in Microsoft. Again, same old thing, short-term overbought, but higher highs and higher lows, right? So they've seized these things. They're continue to keep them bid. We'll finish out with just a few more symbols. I'll get NVIDIA in here, and Tesla. And this is another one that's, the AI developments, so on and so forth. It's overbought, probably due for a pullback. You probably want to keep your eye on the 20-day on that one. I mean, that would be a reasonable level to kind of pull back to. Any of those SMAs could matter, though. But overall, you can just tell this thing's making higher highs and higher lows as a pattern. And then Tesla, and then we'll just take a look at the VIX, and we have to wrap it up to keep this somewhat reasonable. But there's just so much going on. I'm honestly trying to incorporate it into a video, as I'm not a TV editor. So it's been very tough to narrow all these things down to what do we actually include with all the things you have to leave out. But I think, clearly, right, these highs took out this high, they took out that high, this low, clearly higher than this low, higher than this low. Whatever your eye wants to focus on, it's higher. And it's made its way above almost all the SMAs except for the 150 and 200. It's got the 50 rising as well. So again, I think you could put a line across here, which I will, just because we're here, and why not? We're so close to wrapping up anyway. But we just do this, get a nice little resistance line. You may as well just, I think if that gets above the 150, it's in a squeeze market, you may as well just say, yeah, it trades to the 200 at that point. If the market's squeezing up and this gets above that 150 near 202, they'll probably take it at least to that far. But if it wouldn't take much, if it gets above there, it wouldn't take much more to get above the 200 to start taking out highs. So again, be careful, and you might still not be out of the wedge, because if I extend this over, but this is just sort of trading within the lines, I guess you'd have to call it. I didn't extend that far enough. see right there. But yeah, you could still be stuck in this overall scheme. And even if you have a remarkable surge from here, something on order of a 20% surge. So, but this is the kind of stuff that they're capable of. I wouldn't rule it out yet. If they get favorable news, I just don't see how you can rule it out. We know, I've always said at the drop of a hat, these guys will start to buy, and that's really what they do. So I'll try to cover other things in sector situation, but the VIX started getting up there. This looks like something, right, that the VIX was thinking was short-circuited for now. At least it was paused. Because if you think about it, despite all this seems to me a little absurd that the VIX is all the way back down here, in the sense that there's so many things out there in this world that seem to pose risk to economies and countries and societies and the societal order and the banking system and geopolitical and blah, blah, blah. But here you are with the VIX very kind of like mildly impressed with that. At the same time, I'm not surprised because the VIX suppression has been a real thing for a while, right? So it's kind of one of those dual things. But, what do you say about that? I mean, that just, that I don't even know what to say about this anymore because this thing's been tamped down and it really struggles to get to these levels, even when you think it's on the way to doing that. But that's because I think we just haven't gotten that leg, right? That second leg lower. We've had the first leg lower in what could be of what could be more, but we haven't had that breakdown. They've been able to prevent that so far since October. Now, notice where this thing got on the lows though, right? That was pretty darn low. So probably, right, if they let this thing get back down there again and they're just not going to, people are just, this risk isn't going to go away, you're probably, instead of waiting a little bit longer, I would like to wait a little bit longer, but you may have to start dabbling if you want to put some crash protection puts. That's what Ryan covers in the Phoenix portfolio. But if you want to put some of that stuff on, some downside butterflies, just downside calendars, there's so many things you can do. Those kind of things, it might be time to start nibbling if all this news is still out there and they just manage to keep the price higher on these index ETFs and this thing gets down here, knowing how there could be a lot of bad things breaking. I think it's, I hate to say inevitable, so I probably won't do that, but I think it's very likely that a lot of bad news hits this tape and that they start cutting rates. That's what the market thinks. That's what we saw. And that's been the precursor to rough stuff for the market before. And right, I would go with the trend on that and instead of against it. Maybe there'll be some sort of a rescue thing that they pull out. I don't know. But in the absence of something like that, I just think this housing market is the key. And I don't see how, with all the pressure on consumers from inflation and those high rates making everything, really putting probably what most people want out of their reach, I don't see how that sector comes back and starts firing and then the economy's saved and there's a soft landing. Just don't see it. Could be wrong, but that doesn't mean we can't have a massive squeeze or even more, before the reality is priced into the markets. I don't think it's fully priced in now, but again, I'm just one person trying to keep track of things as best they can. I'm not I don't have a team of folks. Unfortunately, Ryan and I would love to have people keeping track of all this stuff for us so we could get informed of what's really going on the ground level. But I think the chances of a recession or very low growth are very high. I think it's far higher than 50-50. I think this year, and that's the way that I've been reading things. That's the way it's shaping up. So I think you've got to be really careful. There's still a lot you can do. You can do a lot of longer term put diagonals as well. These are the things to bring up with your Market Rebellion rep, or even ask Ryan about and get some feedback during the webinar, or use the forums if you're interested in these things, because there could be a lot of opportunity in either direction, right? And you want to be able to take advantage of it while you can. So I've got to wrap things up only because we have to do sector situation, and it's taken all morning just to get this far because of how much stuff's circulating out there. So as usual, I do hope something that I shared with you this week helps you this week or in the future. And I'll be in touch through all the stuff that we do, and check this out later in terms of sector situation. I probably will make that a quick one because I still think it's more about the macro than anything else right now, as opposed to, hey, the cycles are switching and now they're going into this or that. That's what I'd like to do, but we probably need to be back in a bull market phase for me to start talking about, okay, this sector's had its run. Looks like there's this sector's emerging. There could be some rotation into this. That's the kind of good stuff that we would like to get back to, but it is what it is. So everyone take care, stay nimble out there, and thanks for tuning in.